Hello, good afternoon and welcome to World Economy. My name is Blyden Kim. On World Economy today, a Trump signature will appear on US dollar bill in presidential fests to mark American at 250. It will be a conversation and we'll begin from there. The Treasury Department confirmed Thursday evening that President Donald Trump has given perspective of a signature, that a signature will appear on newly printed dollar bill, a first in American history. And there is no more powerful way to recognize the historic achievement of our great country and President Donald Trump than US dollar bills appearing his name. And it's only appropriate that his historic currency be issued at the semi-quincentennial. Treasury Secretary Scott Bessent said in a statement. Treasury Brandon Bash added printing his signature on the American currency is not only appropriate but also well-deserved. The Treasury Department issued its press release about an hour after Vanity Fair reported Trump's signature would appear on all denominations of US dollar bill. It was reported that $100 bills with Trump's signature will be printed in June. Quickly, we'll go on a quick break, and when we're back, Worldview continues looking at perspective.com and with the dollar bill with the signature of President Donald Trump. Don't go anywhere. We'll be right back. Welcome back. As your business, not business, but world economy in that direction. We're talking about the US dollar bill having Donald Trump's signature. Meanwhile, Treasury Brandon Bash added printing his signature on the American currency is not only appropriate but also well-deserved. The Treasury Department issued its press release about an hour after Vanity Fair reported Trump's signature would appear on all denominations of US dollar bill. It was reported that $100 bill with Trump's signature will be printed in June, in time for the July 4th anniversary of a Declaration of Independence, with other bills coming in subsequent months. The federal government began issuing a paper currency in 1861. The surprise announcement comes when Art last week approved Trump's image to appear on the commemorative gold coin of an unspecified denomination, with reports suggesting it may land on a coin larger than an ounce, which is used for the Golden Eagle. There are additional plans for circulating a $1 coin featuring the president's face, but that proposal has run into legal issues due to the Tire Amendment of 1866, which states only the portrait of a deceased individual may appear on the United States currency and security. Trump also recently attached his name to the U.S. Institute of Peace Building and to the recently rebranded Trump Kennedy Center Performing Arts venue in Washington. Critics of Trump's efforts to immortalize himself on currency argue it's contrary to America's democratic tradition. Washington Post art critic Philip Kennicott likened the push to Julius Caesar's decision to mint his face on a coin in 44 BC before being assassinated by senators fearful he would turn the Roman Republic into a monarchy. And now to Spain, as inflation rate jumps in March. Spain's annual inflation rose. The rate rose to 3.3% in March, its highest since June 2024, compared to 2.3% in February, and expectations of 3.7%. The increase was largely driven by higher prices for fuel and lubricant for personal vehicles, reflecting the impact of the war with Iran. And now quickly, let's look at a chart indicating Spain's inflation rate. The chart. According to the chart, inflation in Spain indicated 2.3% in March last year and a slowdown 2.2% to 2% by May. Well, by the beginning of this year, inflation had gone to, after hitting a high point of 3.1%, that was October, a slowdown to 2.3% in 2026 January and stayed at that level at 2.3% in February, but March went higher up to 3.3%, indicating a bit of increment in the cost of commodities in Spain and the currency struggling a bit. And now let's look at the world's riskiest market in 2026. While a handful of stable economies sit near 4 to 5%, countries facing conflict or economic collapse can exceed 30%, highlighting how dramatically risk perception differs across global markets. Let's check out the data, which is as of January 2026, although Turkey was updated in February. According to the chart we have indicating the world's riskiest market in 2026, the riskiest countries are those that expose war, sanctions and economic collapse. Belarus, Lebanon, Sudan and Venezuela each have the highest equity risk premium of 30.9%. Belarusians have faced intense political repression as they responded to the contested re-election of Alexander Lukashenko in 2020. Lebanon is considered a failed state as governance and the economy have collapsed, while armed groups are present on the streets. There has been a civil war in Sudan since 2023, causing a devastating humanitarian crisis. Meanwhile, Venezuela has a long history of instability and mismanagement of its oil industry and economy sent the once prosperous nation into disarray. Cuba, Ukraine, Syria and Yemen, which have also experienced conflict or sanctions, are among a cluster of countries with a risk premium of 19.8%. So countries considered safer investment bets. Well, you've seen the list of countries that we've mentioned all through. Let's talk about those that are safer investment bets. Some of the safest countries include Canada, Germany, Switzerland, Singapore, Sweden and the Netherlands. With risk premiums, the risk premium at 4.2%, investors likely treat them interchangeably. The US has a slightly higher premium at 4.5%, which may reflect recent political polarization and higher equity volatility. Indeed, South America dominated investor conversation earlier this year amid economic uncertainty, questions around the independence of Federal Reserve and the depreciation of the dollar. It are one of just 19 countries that have risk premium below 5%. In Europe, Europe is not homogeneous. Certain countries where economies were hit by the 2009 debt crisis have higher risk premiums. Spain and Portugal sit at 5.8%, Italy at 6.7% and Greece is 7.1%. And back to Africa, as Zimbabwe gold trade hit by global tensions and soaring shipping costs. Earlier in March, reports showed that Ghana had begun exploring alternative export routes for its gold shipment amid persistent tension in the Middle East. Over in Southern Africa, Zimbabwe is facing similar challenge owing to the same problem. Both countries are facing difficulties exporting gold due to disruption in the Middle Eastern trade route. Ghana's logistic challenge stemmed from disruption in flight to the United Arab Emirates, which has long been an important center for Ghanaian gold shipments. The UAE is a critical destination for gold from both countries, with 45% of Zimbabwe's gold export revenue coming from there last year. A shipping disruption have forced vessels to reroute around the Cape of Good Hope, increasing transit times and raising costs. Container shipping rates have risen sharply, notably those between Turkey and China, impacting profitability of exports. Now back to Europe. As Europe gross domestic product GDP is projected to grow by only 2.3% on average in 2026, held back by sluggish growth in major Eurozone markets such as France, Germany and Italy. However, other regions are expected to see faster economic expansion, especially in Southern and Eastern Europe. This data showcases a forecasted European GDP growth rate for 2026 utilizing data from the International Monetary Fund (IMF). Across the old continent, growth is constrained by high regulation, weak demand and a difficult global environment with heavy export-led economies like Germany particularly impacted. Let's start with Germany's year-long hangover. Germany, the third largest economy worldwide, is facing deep structural problems with its market structure following 2 consecutive years of recession. Europe's largest economy barely grew at all in 2025 and is expected to see just 0.9% growth in 2026, ahead of only 2 other European countries in the member states. And now let's look at the chart indicating Europe's GDP growth forecast for 2026. Between 2005 and 2019, Germany experienced what has tamed the labor market miracle, an era of economic expansion powered by high employment growth, low interest rate and cheap energy. However, this period came to an abrupt end with the COVID-19 pandemic and especially with Russia's invasion of Ukraine, which sent energy prices skyrocketing, all but halted Germany's growth, as well as escalating conflict in the Middle East. The German industry, the pride of the country, is increasingly being squeezed by both US tariffs as well as massive Chinese competition. Looking at Europe's other major economies. Beyond Berlin, the news remains grim for the other major economies of Europe. France is projected to match Germany's sluggish growth of just 0.9%, while Italy is tied with Austria for the continent's slowest growth, 0.8%. Russia, 1%, is still held back by the high interest rate and low domestic demand of its wartime economy, while the United Kingdom, 1.3%, fares only slightly better. Turkey, the top economy of the Eastern Mediterranean, faces a growth projection of 3.7%, although its results are tempered by an inflation rate hovering around 30%, following peaks in 2022 and 2024. And now to Asia's Japan 10-year yield hits 27-year high. Japan's 10-year government bond yield climbed to around 2.37% today, reaching its highest level since 1999 as an oil-driven inflation shock linked to the Middle East conflict reinforced expectations of a near-term interest rate hike from the Bank of Japan. Hawkish bets were further supported by a sharp weakening of the yen, which has remained under pressure from rising energy costs given Japan's reliance on oil imports from the region. Last week, the Bank of Japan kept its policy rate unchanged but maintained a tightening bias with Governor Ueda, a leaving door open for a possible April hike. Analysts are now pricing in a potential 25 basis point increase to 1% at the central bank's April 28 policy meeting. Oil prices stayed elevated amid conflicting signals from the US and Iran regarding diplomatic efforts to resolve the conflicts. And now we'll go on a quick break, and when we're back, world economy continues looking at half the world and oil that comes from half the world being efficient enough for the rest of the world. We'll have a conversation around it when we're back from the break. Don't go anywhere. Welcome back to World Economy. My name is Blyden Luket. In World Economy, the second half of the outlook, I will talk about just 5 countries that produce half of the world's oil in 2025. Just 5 countries produce half of the world's oil in 2025, with the US, Russia, and Saudi Arabia alone accounting for nearly 40% of global supply. That level of concentration means a small number of countries have an outsized influence on global oil supply. The data comes from the U.S. Energy Information Administration and is a January to November 2025 annualized average crude oil and least condensate production by country, the latest data available as of March 9, 2026. The U.S. was the world's largest producer of crude oil and least condensate in 2025, producing 13.58 million barrels per day, comfortably ahead of Russia at 9.87 million barrels per day and Saudi Arabia at 9.51 million barrels per day. Combined together, those three countries were responsible for 39% of global crude oil production in 2025. The chart we are about to see shows the world's crude oil production in 2025 by country in millions of barrels per day and each country's share of global production. The chart, well, according to the standing from number 1, a move 7 for the United States of America, and number 2, Russia, and number 3, Saudi Arabia, Canada, Iraq, China. Let's look at further standings. After the top tier, production dropped sharply. Canada ranked 4th at 4.94 million barrels per day, followed by Iraq at 4.39 and China 4.34. In other words, the U.S. alone almost produced more crude than Canada, Iraq, and China combined. Iran was the 7th largest producer of crude oil in 2025, pumping 4.19 million barrels, which equates a 5% of the world's production last year. The Middle East is the largest oil-producing region. While the U.S. was the single biggest producer, the Middle East remained the largest regional bloc in the ranking. Countries from the region produced 32% of the world's crude oil in 2025, or nearly one-third of the global total. Saudi Arabia, Iraq, Iran, the United Arab Emirates, and Kuwait all landed in the top 10. That clustering help explain why Middle Eastern supply continues to play an outsized role in global oil balances, even with the U.S. holding the top spot individually. The war in Iran has led to significant disruption in crude oil production and trade in 2026, with many Middle Eastern countries' production facilities shut down and destroyed. Even if the war were to end soon, many facilities will require significant reinvestment and time to repair, along with high levels of uncertainty across the key energy trade routes, that is the Strait of Hormuz. After the top 10, oil production falls off quickly. The concentration of output in a few countries and regions becomes even clearer. Lower down the ranking of oil producers, the top 10 countries accounted for 72.2% of global production, meaning all remaining producers combined contributed less than 28%. That long tail includes countries such as Kazakhstan, Norway, Mexico, Nigeria, Libya, and Guyana, each of which adds a meaningful barrels to the market without approaching the scale of leading producers. The result is a global crude market where a handful of countries still matter most for overall supply trends. Still looking at the oil sector, Brent rises for second session. Brent crude futures rose towards $110 per barrel today and hit a high since June 2022 amid skepticism that the U.S. and Iran could reach a deal to end the war soon. Reports indicate the Pentagon is considering sending up to 10,000 additional ground troops to the Middle East, while Iran is said to be mobilizing over 1 million troops in response. Meanwhile, President Donald Trump extended the deadline for a planned strike on Iranian energy infrastructure to April 6 to allow for negotiations, saying talks with Tehran were going very well. Trump also noted that Iran had allowed 10 oil tankers to pass through the Strait of Hormuz this week as a gesture of goodwill, while Treasury Secretary Scott Bessent said an insurance program to support shipping through the waterway would begin soon. Brent prices have remained up roughly 50% since the conflict began, as Tehran effectively closed a narrow waterway through which about a fifth of global energy flows. And now let's look at the commodity market and what the price of the commodities are in the market. The commodity market. Commodity market begins with the price of U.S. crude oil at $96 per barrel this afternoon, gaining 2.2 points this afternoon, a 2.33% appreciation in terms of price. Brent, representing Nigeria's price benchmark, a price level stands at $110 per barrel, upward 2.62%, natural gas gaining, gasoline upward 2.08%, heating oil also gaining. A gold price gaining 40 points this morning at 4,420 US dollars per ounce, gaining 0.91%. Silver dropping a negative 0.4%. Let's look at further commodity markets. The price of soybeans is upward by 2.4 points, 0.2%. Wheat price gaining, coal price gaining 3.24%. A steel price at a price of 3,124 Chinese yuan per ton, upward by 0.06%. Back to Africa. The Democratic Republic of Congo, Congo-DR, has revoked a 79-block lithium exploration permit held by the Congolese subsidiary of Australian mining firm AVZ Minerals. AVZ Minerals has 30 days to appeal the decision, which affects its Manono extension project and deepens an ongoing dispute over mining rights in the area. The revocation is part of a broader trend in Africa, where governments are tightening mining regulations and promoting resource nationalism to ensure local benefits. The local benefit from mineral wealth. Foreign mining companies in the DRC and other African nations face increasing regulatory risks, operational costs, and potential legal disputes due to stricter enforcement. Finally, on world economy, let's look at a European stock market as stocks are lower. European stocks edged lower today, with both the Stoxx 50 and Stoxx 600 slipping by around 0.2%, as initial optimism over the extension of the truce announced by President Trump faded and rising oil prices continue to fuel inflation concerns. ASML Holdings at negative 1%, HSBC Holdings negative 0.8%, Shell negative 0.3%, and Siemens a negative 1.4% were in the red, while AstraZeneca jumped 3.2% and ESAP went up 1.4%. Despite Friday's drop, the Stoxx 50 is up 1.1% on the week, and the Stoxx 600 gained 1.3%. Let's conclude with global stock market. Most of the stock markets are downward, but let's look at the global stock market this morning. Global company stocks this morning indicating the prices of different company stocks. First, we look at Apple at $252 per share, upward by 0.28 point, a 0.11% appreciation. Tesla falling negative 3.59%, Microsoft dropping negative 1.37%, Amazon a negative 1.97% drop this morning. This afternoon, Meta also falling negative 7.96%. Nvidia, no significant change at $171 US per share, but no significant change. JP Morgan, Oracle, J&J, P&G, ExxonMobil gaining 0.3%. The rest of them all negative. Alphabet, Goldman Sachs, all are falling this afternoon. There's been a twist and turn in the different market and global economic standings. But here we have to draw the quarter in today's edition of World Economy. Thank you for being a part of it. My name is Vladimir Kim, and thank you for watching.